Let's pivot now and talk about the implications of all of this for markets. So let's think about the stories that we've had through today. China, maybe some evidence that we are going to start to see some easing of the lockdowns in Shanghai and Beijing. We've just had a series of super high inflation prints coming out of the Eurozone as well, largely impacted by A, China's lockdown, and B, the energy crisis that Maria was just talking about there. How should we be thinking, therefore, about investing outside of the United States? Or do you just basically look at the United States and say, here is an economy that continues to do well. Why do I want to invest outside of those borders? Robert Schein, CIO of Blanke Schein Wealth Management, joining us now. Robert, great to speak with you today, and thank you for joining us. We just spent the last half hour talking about what is happening in China and the difficulty of containing COVID. We've talked about what is happening in Europe, the issues with Ukraine, and the inflationary impact that it's having. What impact is that having on your thought process when you think about investing money right now? Do you keep that money in the United States, or do you put it to work elsewhere?
Guy, thank you for having us, and it's a pleasure being with you today. And for all those on Memorial Day here in the United States, we thank you for all your service, for the friends and family. We appreciate that. As we go and allocate capital, it's been a challenging year, no question. We've had some cash, we've put it to work, but as we look at the global landscape, we have to consider everything you just discussed. The Russia-Ukraine, the geopolitical concerns there. We also have high energy prices, which ultimately are working into the balance sheets of corporate America and around the world. And that's ultimately, that and wage inflation is really the challenge right now that we're seeing when we're allocating capital and investing for our clients. But there's always an opportunity, as we're seeing. And then if you look at the last 7 weeks, we had, markets were selling off. And so there's seller exhaustion. And we got a really welcome sort of bid to the market this last week as we close the weekend.
Do you think we're going to be seeing, so two questions really sort of coming up off that. A, do you think yields have peaked in the United States? Do you think inflation has peaked in the United States? It looks like here in Europe that the inflation peak is in front of us. And B, do you think that's just a temporary respite when it comes to the equity market? Do you think there's going to be a better entry point further down the road?
Yeah, that's a great question. Yeah, if you look at yields here, at the 320 level is sort of the peak that we've seen. Now we're at the 274 for the 10-year. It seems to be just that. It seems to be a good entry point for fixed income, because fixed income hasn't been your friend this year if you're investing and allocating capital. Right now, we believe it's been a 10-year story, even last year, going from the 170 to the 320. We do believe that we have seen the 320 is the top end of the fixed income range right now. And so, yeah, there is opportunity there in the fixed income markets because the 10-year is telling the Fed exactly where it needs to be. We all know that the Fed is behind the curve, and we're seeing that play out.
So what does that mean in terms of the way that you're investing? Do we continue with the value rotation? If yields have the potential to go back up, that would seem logical. On the other hand, if they may have peaked, do I want to rotate back towards growth?
Yeah, so we don't believe that the market bottom is in just yet. So we're experiencing what you see as a bear market rally, if you will. So there's a potential for the lower lows to ultimately play out later this summer. That being said, we do believe, even from this point forward, that the equity markets will be higher by year end. So there is an opportunity to put capital to work. We like energy sector, as we know that, energy is still being embedded in terms of every corporate balance sheet. But at the same time, it's an opportunity for clients if you want to be sector specific as an opportunity going forward.
How much higher, Robert? How much higher do you think equity markets could be as we come through into year end?
Yeah, we could see, even a bear market rally, we could see an easy 10% rally from here. But then again, like I said before, you have to be careful. We're going through, anywhere from the August to October period of time. Historically speaking, Guy, we looked at some research that came across our desk here, and, it shows that, from January through basically September in a midterm election cycle that we're in, if you take out 2008, they go 94, 98 all the way through. You're seeing from January to basically October, the market basically trades flat to down. But then when you get closer to the midterms, as we're in a midterm cycle right now, markets seem to continue to go higher from that point forward. And really what that really tells us is that it's all about certainty. Markets don't like certainty. We're getting the certainty from the Fed. Hopefully sooner than later, we're getting past some of that information, the transitory conversations or what the Fed's going to do. And then we'll get back to the year end and we'll get the elections behind us. And markets really like certainty. So we kind of have to grind our way through it through the summer right now. But, be careful, be cautious, wait for some markets to provide opportunities. And then I think between now and year end, we can see, at the year end, we can see some higher markets.
So, sorry, just to come back to the question, we're trading 41.58. That's where we closed yesterday, Friday on the S&P. Decent bounce off the lows below 4,000. Are we going back up to the 4,800s? How much higher could this bounce take us?
Yeah, there's some resistance around the 4,500 level later on, but it's also technical driven. So you got to be careful, Guy, as the markets grind higher and then technical programs kick in. We can see a quick sell off as soon as we get to some of these levels.
If inflation turns out to be stickier and the Fed, as you say, maybe has to be more aggressive, do you think the equity market can deliver that kind of sustained rally?
Yeah, so what's going to happen is at the end of the day, corporations and the C-suite executives are going to preserve the bottom line. So ultimately what that means is we're going to see corporations going from a wage, inflation embedded in the corporate balance sheets to laying off later on a late cycle. There are some signs of some recessionary pressures. We don't believe that there's going to be some recession just yet. Obviously, you need 2 quarters of negative GDP for that. But that being said, the markets haven't priced in any good news. And as we get closer to year end, we're going to see more and more good news play out. And then as corporations sort of want to preserve the bottom line, the top line revenue is growing. We're seeing all, S&P 500 top line revenue is growing. It's the bottom line that everyone's concerned about. And corporations could start laying off if they need to preserve the bottom line. And that'll preserve revenues going forward.
Robert, great to catch up. Thank you very much indeed. Robert Schein of Blanke Schein Wealth Management. Greatly appreciated.